Hi there. Welcome back to yet another episode of E.M.I. That's Economy, Markets, and Investments for you. This is the E.M.I. for the month of May. Like always, in this month's E.M.I., we have four key questions. First, what is the end game for the United States? It doesn't look like it's tariffs. Second, where must India focus? Which sectors must India focus on to increase its export market share? Third, what is that one key variable that you must track to get a sense as to how global macros are responding to tariffs? And lastly, the upcoming eighth pay commission. How much of a consumption boost? What is the end game for the US? This is what we're trying to address in this slide. Tariffs doesn't seem to be the end game for the United States. Currency seems to be. The US wants to weaken its currency to a certain extent. We don't really know how much it wants to weaken its currency. It wants to weaken it very similar to what it did in 1985. So there was something called the Plaza Accord in 1985, where US decided, along with four other countries, that it would weaken the dollar and bring back a fair bit of competitiveness to the US economy. Now, we'll answer some questions as to why did the dollar become so strong, etc. But before we get into the details, take a look at this bullet flow here. So we're talking about tariffs, and then we talk about the Bretton Woods system, the gold standard, the Plaza Accord, the Louvre Accord, and we talk about the current scenario. The Fordney-Macomber tariff, 1922, a set of tariffs were imposed in the United States. This was post the First World War to shield US manufacturers from cheap imports. Soon after, in 1930s, another set of tariffs were imposed. This was the Smoot-Hawley tariffs. This was largely to protect the US from the Great Depression. After this, you had World War II, and after World War II, you had a global system that emerged called the Bretton Woods system. The main focus of this system was apart from a lot of other highlights, one main highlight from this discussion point of view is that major currencies, they were pegged to a fixed dollar. So all these currencies that had devalued, that had weakened their currencies earlier, they're now pegged it to the dollar. The US dollar became a reserve currency, and it was now being backed by both gold, and it was also convertible into gold. And this was the start of something called the gold standard. Now, under the gold standard, apart from convertibility, what we actually saw was for a few decades, the US started spending quite a bit, a lot of overspending that led to a very large trade deficits and, more importantly, a very large fiscal deficits. The dollar then slowly started losing credibility as a reserve currency, and it was not able to convert this gold standard. Under the gold standard, it was not able to convert its currency into gold at the pace it was supposed to. And this sort of led to the end of the Bretton Woods system and the end of the gold standard. So we're talking about this period in 1971. What happened after 1971 is a very important from this discussion point of view. Early 1970s, US had very low interest rates. That led to a fair bit of inflation pressure, but most important was there was an Iranian revolution, there was OPEC's oil embargo on all those countries that supported Israel. All of that led to a very sharp increase in crude prices. So inflation was moving up, crude prices started moving up. That led to very high inflation in the United States. And how did the Federal Reserve respond to very high interest rates in the United States? By increasing interest rates sharply. This was under Paul Volcker, and it's called the Volcker shock. That led to a significant increase in Federal Reserve interest rates. And when Federal Reserve interest rates move up very sharply, the US dollar also moved up very sharply. And once the US dollar moved up very sharply, that you can see in this chart here, see a very sharp increase in the US dollar. It was at this point that the US decided they could not continue with such high US dollar levels, and they wanted to bring it down. And that is when the Plaza Accord came in. The Plaza Accord led to a very sharp drop in the dollar. The weakening of the dollar happened at such a fast and such a quick pace that the US stepped in again in around 1987, 2 years later, in something called the Louvre Accord, where it said, let's reduce the pace of this depreciation. We don't want it to depreciate so much. So there was a stop that was put to the pace of the depreciation. And after that, you can see how the dollar responds. The dollar sort of bottoms out in the late 80s period after the Louvre Accord. Now, why is all of this relevant? We feel that all of this narrative around tariffs, with this 90-day pause, we understand that the elevated tariffs that the US had announced in April was not here to stay. It's something else that the US is looking at. What is it looking at? We spoke about in the last E.M.I. about how the the US's focus appears to be reducing its trade deficits first, and not as much on the tariffs. Now, why the focus on the trade deficit? Because if the US reduces its trade deficit, what it's eventually trying to do, it is trying over a period of time to create some space on the fiscal front, but more importantly, it is trying to weaken its currency that has actually run up a fair bit from 2010 to 2025, these 15 years, from under 80, the dollar index has gone up to as much as 110. They want to bring the dollar down to a certain extent. We don't really know how much they want the dollar to weaken. They want to claw back a certain amount of competitiveness of the United States. That is one part that appears to be the main part. But the other angle is also trying to blunt China's edge that it is developing around tech. So you can say there are two aims here. One is trying to blunt China's edge around tech. But the more important and the structural part that you have to remember here is remember this flow of events and how at every point in time the US has tried to weaken the dollar and bring back competitiveness. That appears to be the case this time as well. That is the more structural component at this time. Then we look at export market shares. I recall we had done an E.M.I. Around October of last year, where we spoke about how China's export market share, even after US tariffs in 2018-19, did not really drop. It actually started going up. There was a very marginal sort of a drop in 2018-19, around 10 to 20 basis points. After that, it only went up higher. So how has China's export market shares grown from 2007 till now to 2023? You've seen a 5.5% increase in China's goods export market shares, global export market shares. Now, where does India come into this entire picture? 70 basis points is how much India has gained in market share. So from 1.1, it has gone to 1.8. And a good part of this has been in the first decade or so. The last few years has not seen as much of an increase. The interesting bit that we understand, rather we see here, is China has gained 5.5% export market share, India 70 basis points. You can see UAE has gained 80 basis points, and Vietnam, such a small country, has gained export market share of 1.1%. This is global export market share. Now, then what we do here is we break this down, just China and Vietnam. Why just China and Vietnam? So the opportunity that we have now with the tariffs, we touched upon this in the last E.M.I, but briefly, if I had to reiterate, the point that we're trying to make here is this is another China plus one. So during COVID, there was a China plus one that saw a fair bit of investment coming into India because the world wanted to de-risk from China. This appears to be a second opportunity India is getting at another China plus one. So what we're trying to do here is we're just adding China plus Vietnam, looking at their export market shares in manufacturing particularly, and certain segments, breakups within manufacturing. How has manufacturing grown? From 12% export market share in manufacturing, China plus Vietnam's export market share has grown from 12 to 22. So roughly around a 10% increase in export market share in manufacturing just from China and Vietnam. Now, one would think that, okay, we're looking at China plus Vietnam, 90% or 95% of these export market shares are only going to be China. It's not going to be Vietnam, given how small Vietnam is. But it's very interesting that we see, if you look at this segment here, you can see that Vietnam has seen market share gains more than China in certain segments over these last 16 years. What are these segments? Office telecom. Most of this 12% increase in market share, most of it is only from Vietnam. Then comes electronic data processing, and then comes telecom equipments. Where is that? Telecom equipments here, and clothing. These are the four segments where Vietnam has gained almost a very large increase in market share, larger than China. And it's very interesting to note that because Vietnam's export market share growing with the size of the economy being as small gives everybody an idea as to how India probably can also do it, given that it has a larger working age population, and the and India appears to be an increasing beneficiary from China plus one, the second round of China plus one, plus this differentiation from a US point of view on the tariffs. You look at where India stands on minimum wages. India's monthly minimum wages is roughly around $56 a month. Vietnam's is around 197. So India stands to gain there. And even more important is if you rank countries by working age populations, India is number one there. Now, why does working age population matter? We've seen a lot of investment happen in electronic manufacturing. You've even seen a lot of investment shift into India on the iPhone space. All very large manufacturing needs a large chunk of working age population availability and also them being skilled. India offers that to the world, in addition to the fact that on a relative basis, cost is also less. So, second largest working age population in the world, second lowest on wage costs. This will be a very big positive for India going forward. What is that one key variable that markets will be looking at, and rather what you should be looking at? When you look at tariffs, it's very difficult to understand how tariffs are going to impact macros because data will be very, very late to come. By the time you get GDP numbers and you see what the impact of the tariffs are on GDP, markets would have already reacted. We take a small example here. We take the Federal Reserve's manufacturing capex surveys for Federal Reserves, which is Kansas, Richmond, Dallas, and Philadelphia. The last time in 2018-19, when tariffs were imposed, you saw a very sharp drop in capex intentions, or rather the capex surveys saw a sharp drop. As of April, you can see a very similar sharp drop, a sharper drop rather, given that the tariffs are higher this time around. You've seen a very sharp drop in these capex surveys. Last time around, you saw PMIs come down very sharply. You've not seen that happen this time around, mainly because the markets are still not sure what the final tariffs are going to be. There are a significant amount of tariffs that were imposed, and then there was a 90-day pause. Now 245% tariff on China became 145. Now it's almost 30%. So there's a lot of uncertainty. Markets feel that tariffs are not going to be in 3 digits or 2 digits, high double digits. It has to come down and settle down, but markets are still waiting for some clarity. So capex is going to be the most important variable you should be tracking. That will reflect in PMI numbers. And if it reflects in PMI numbers, it will eventually reflect in your GDP numbers as well. One positive, though, is the last time around, you didn't see the markets were significantly worried about tariffs causing inflation. We didn't see that the last time around, mainly because most countries, they took a hit on their margins or they took a hit on their currencies. They did not really pass on a large part of those tariffs. It's likely that that might happen this time around. So we might not really need to be too worried around the inflation front from a US point of view. So capex is going to be the most important. Now, why is capex important? Now, apart from being an indicator of future economic conditions, capex trends are very important in construction and manufacturing and tech. They have a lot of implications from a job market point of view. And the more the capex surveys give you a negative or a soft outlook, it would mean that capex decisions of countries could get delayed or postponed. That will eventually have an impact on GDP growth as well. So the one variable that you have to very closely watch is what are your E.M.I numbers looking like? And more importantly, how is the outlook for capex? Now we come to the last part of the E segment, the economy segment, the eighth pay commission. This is something that everybody is waiting to see what the impact is going to be from a consumption point of view. So the chart on the left shows all the previous pay commissions. So what is the pay commission? This is the central pay commission. It happens every 10 years. A recommendation of the central pay commission goes to the ruling government, which invariably accepts all the recommendations. And there is an increase in the salary for all these central government employees. Remember that public sector units, the PSUs, they have a separate pay commission, pay system. This will not include the PSUs. This will also not include state governments. This is only for central government, direct central government employees. So the last pay commission is the more relevant one here. So 40 basis points, so 0.4% of GDP was the impact that the sixth pay commission had on consumption. The seventh pay commission had 0.66% of GDP impact on consumption. This time around, if we go by the same seventh pay commission pay growth, etc. So the seventh pay commission saw a fitment factor. When you say a fitment factor, it's basically a number which is multiplied to your basic salary. The fitment factor the last time around was around 2.57. We don't know whether it's going to be the same fitment factor. If it is the same fitment factor, the growth rate might be the same, consumption impact might be the same. If the fitment factor is much higher, the impact on consumption could be even higher. If it's a little lower, then the impact could also be a little lower. But on the whole, ballpark, it does look like the impact of the eighth eighth pay commission, would be somewhere in the range of around 0.7% or 0.69 or 0.7% of GDP, which translates to roughly around 2.5 lakh crores 2.5 trillion rupees, 2.5 lakh crores plus of consumption boost purely from a pay commission point of view. Now, what are the employees that will really benefit from that? So you have roughly around 3.7 million central government employees, 1.4 million of active defense. This is from a pay point of view, and from a pensions point of view, you have 3.4 million civilians and 3.6 people in defense. So on the whole, roughly around 12 million people will benefit from the eighth pay commission, both in the form of pay and allowances and pensions. This is a fair bit of a boost from an economy point of view, given that consumption has to be the focus of the economy going forward into FY26 and 27, given the uncertainties on the global and the external front as well. Once the eighth pay commission is finalized and the recommendations are adopted and implemented, over a period of time, state governments will also announce something similar in direction, and PSUs as well. State government employees, we roughly have somewhere around 11 million or so or plus of state government employees, which is almost the same number of that the eighth pay commission will be targeting, and PSU employees of around, let's say, 1.5 million. So roughly around 12.5, 13 million additional employees would get similar pay hikes under their PSU pay revisions and state government pay commissions, which will then give an extra layer of boost for consumption for the economy. Then we come to the last segment of the economy part. Four key variables that stood out for us last month from a macro point of view. This is for FY25. Toll collections continue to hold up fairly well. You're seeing e-way bills also hold up a fair bit, and e-way bills over here. You're seeing port traffic hold up quite well. The negative here is you can see residential sales of the top 7 cities. They saw a fair bit of a contraction in the last few months of the year. That has not really been much of a positive. But on the whole, economic activity continues to sort of hold up. There isn't any appreciable indication of weakness from an India domestic macro point of view as yet. Markets in April, we'll just quickly run through this. This talks about why US 10-year yields saw a very sharp whipsaw in the month of April, a very sharp drop and then a very sharp increase. The very sharp drop was largely on fear and concern of a recession, etc., and that the Federal Reserve would probably cut rates as a result of that. There was a knee-jerk reaction in the US debt market. But very soon, you saw a very sharp increase in the US debt market, US 10-year yields. A lot of theories and conspiracy theories were doing the rounds. A lot of people immediately started blaming China, saying China is actually selling US treasuries and that's why this is happening. And then some people started saying it's actually bond vigilantes, those who don't like US spending continuously. But the real reason was not so much that. You saw immediately after the tariffs, US equity markets started coming down quite sharply. That triggered the margin calls. So because these margin requirements, were triggered, all the levered investors, they had to sort of sell their liquid assets that were held in US treasuries. That led to the first leg of US treasury selling. Now you have another reason. You had a lot of macro hedge funds that are short US treasuries in the futures market, and you also had people who were engaging in the bond basis trade. This also led to another leg of US treasury selling because they had to, given that US treasury yields had reached certain levels. So what we sort of understand here is that de-dollarization, China selling, bond vigilantes, loss of US credibility, etc., these weren't really reasons that led to a very sharp increase in US 10-year yield. As we speak, US 10-year yields are still hovering at around 4.5% or so. That's largely because there is still uncertainty around tariffs and some uncertainty around the US tax cuts being extended post December of 2025. So markets are extremely sensitive to US yields now. One other important point that we're trying to highlight here is the Federal Reserve holdings of US treasuries was around 27% in around 2022. It has come down quite sharply by nearly 10% as of now. Now, when the Federal Reserve is holding lesser and lesser of US treasuries, who has to cover the slack? It is US primary dealers. US primary dealers, their absorptive capacity is much lesser. So which means they are not buying as much US treasuries as they used to. The Federal Reserve is also not buying. And now it means that the US treasury market is becoming increasingly very price sensitive. these US yields should start normalizing at some point in time, but it will happen probably only after the markets get a sense as to what the certainty is around US tariffs, US trade, US fiscal, etc., which might take some time. Then we touch upon some valuation metrics. So the point that we were trying to highlight here in this slide is about how on the earnings front, Germany continues to top the charts on earnings growth front. This is something that we talked about in last month's market insights, where we spoke about how the dollar weakness that we saw was directly related to the fact that euro had seen a fair bit of strength. A lot of money was going into European equity markets, given the valuations there and given prospects of growth there. We then look at where market cap to GDP is now. Market cap to GDP is somewhere around 126% of GDP. It's come off from 145+% or so, but nevertheless, it's still at elevated levels. Your price to 1 year forward, price to earnings ratio for large cap, mid cap, and small cap, all of them saw an inch up in the month of April. Now we come to the last segment. What must you know before investing? Like always, we look at in detail lump sum investing. The last time we looked at SIP investing. So the two key pointers you need to really take away from this chart is this. It tells you that any lump sum investment, historically, the probability of lump sum returns is below 0. 5 years, at 5 years, there is a 0% probability that your lump sum investment in the large cap space has given you negative returns. Which means if you are a lump sum investor, you must invest always from a 5-year plus time horizon if your investment in equity is 100%. It also tells you that the probability of lump sum returns being less than 12% CAGR starts reducing over time. But if you recall the same chart we did for SIP, the drop in probability of lump sum returns being lower than 12%, it actually fell at a much faster pace. Lump sum returns, they seem to be falling at a much slower pace. We all understand why. Because the framework of lump sum versus an SIP, there is always a cost averaging angle in an SIP from a framework point of view, which means whenever there is a market drop, market correction, the cost gets averaged and it really works as leverage in the years to come when markets turn around. That doesn't happen with the lump sum, which is the reason why the pace of probability is much slower. Now, the most important, this is the same thing we did for SIP, we're doing the same thing for lump sum. What we did in the a couple of months ago in the E.M.I, we were trying to understand if your SIP return, XIRR, is less than 12%, what can an SIP investor do? We arrived at the conclusion that an SIP investor should continue his SIP for at least around 10 to 12 months. And if he did that, his return of less than 12% XIRR would actually become 12% plus in a matter of a year or so. We are trying to do the same exercise for a lump sum. We try and see, okay, if a lump sum investor is looking at a less than 12% CAGR return, can he wait it out like an SIP investor? And if he does wait it out, will his 12%, less than 12% return, will it actually go back to 12% plus? If it does, how long does it take? That's what we're trying to address here. So if we're looking at the same time frame, 7-year time frame, you're looking at a 10-year lump sum time frame, 12-year lump sum time frame, and a 15-year lump sum time frame. What all these charts tell you is that continuing your lump sum for a longer period of time does bring your return up. If your return is less than 12% CAGR, it does come back up to 12% plus CAGR, but it takes a lot of time. So on average, anywhere between 60 to 128 months on average is what it takes for a less than 12% CAGR to go back up to 12% plus CAGR. Now, this is an average. The best case scenario you can look at, let's say for a 7-year lump sum investor, 25 months is what you see. Or let's say a 10-year investor, the highest in the recent phase is around 46 months. The highest in the recent phase here is 39 months for a 12-year lump sum investor, and somewhere around 20 to 30 months. So the point that we're trying to highlight here is, as a lump sum investor, if you have less than 12% CAGR, if you hold on to your lump sum investment, it is not as beneficial like it was for an SIP investor. So this sort of reiterates the importance of SIP as a framework over that of lump sum. And lastly, we end with this quote from an American technology writer, where he speaks about how It's not information overload that is the problem. It is filter failure that is the problem. Till the next time, happy investing. This is Arjun signing off.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.